Hey everybody, it's Saturday night. Let's talk about making money next week in the stock market. It's the Ken's Stock Options Straddle podcast. That's right. This is rapidly going to become nothing but how do you straddle with stock options. It's a tactic, I guess, as a options trader that I came across before I had heard what the term was. But now that I understand what the term is, it's a common thing. And I built this algorithm to analyze stocks so that it just gives us the companies that we're supposed to take advantage of in the straddle strategy. And what the straddle is, I don't know why it's named this, but let's just theorize. It's a podcast. Let's have some fun. Straddle makes me think of the word saddle. Straddle also makes me think of the term in poker where somebody puts a bet up after the big blind and gets to act last and puts more money in the pot. It sounds like a volatile type of thing, but here's what I'm assuming straddle in the saddle, I guess, is really all about, which is you're picking a company and you're saying this company is going to have a certain amount of volatility in the upcoming week, meaning Adobe is currently I'll actually look them up and give you more current information so that it's really, really accurate. Adobe, which is showing up as number one on one of these lists, but not number one on the big list, which I'll explain in a second. But Adobe right now is $371 a share. Okay, so they went up. Like this needs to be updated. Let's actually update their option because I want to see where it actually appears now. So we need to go into the options cube. We're going to update the current information for Adobe. They're now at a 370 call. They're 610. They're between 610 and $650 for a call option, 445 and 475 for the put option. So you're straddling, you're going potentially both ways, meaning you're allowing Adobe to go up or down. It costs about a little over $1,000 to try to buy those options, which have a fairly good spread range, pretty good, meaning you'll probably be able to get very close to that price, sort of, as the market opens and stuff changes. But in theory, you don't want to pay more than $1,000 really to try to get a call and a put and straddle Adobe next week. Is that a good idea? Well, here's what I wanted to do with the algorithm, and it's working well enough that I'm ready to discuss how we'll talk about this every day. Because I want to do a simple video or a podcast where I discuss the stocks. I'm like, guess what? I refreshed the algorithm today and updated some options. And guess what? Here's the top list of stocks that it says to straddle for this week. That's what I want to tell you. Like, I don't want to tell you this order right here, which is how much they went up on Friday. That's not the best order. The order is related to this number over here. It's the rating rank percentage. And Adobe's rating rank percentage is 20. That's not good. You want this number to be less than 5, definitely less than 10, and really less than 5 is premium stuff. So Twilio is actually a premium company. Adobe, not as much, because this is too expensive. They have to move $10. While they probably will, it's still an okay number. It's very expensive. Twilio is much cheaper and only has to move over $2 and about $2.75 or more. Call it $3, like round up. Be like, Twilio's got to move $3 and go from whatever they are to something that's $3 away from that at some point this week. They're at 51.21 right now. So if you want to update the Twilio options to see if this is really a good deal or not. Oh, what is going on? Oh, I'm all screwed up with the mouse. But point is, I won't worry about that too much because I want to talk about something else here in this podcast, which is I want to make it easy, like I was just saying, to look and say who's the top picks. Well, because it's related to this rating rank sheet, what you have to do is you have to grab this information and put it in a different sheet so that we can sort it properly. And that's what I'm doing. And we have an absolute value of the rank, and these are the top companies. Remember I said anything under 5% is really good? 5% is all of, even down to Goldman Sachs. Under 5 is all these companies, right? So these would be companies that it would say you straddle these companies this week. Now let's double check and make sure that these are the ones we want by double checking the options prices and making sure they're accurate. So, number one, IBM at a 2.6. IBM was successful last week. And they, I noticed they had a representative at the hearing in International Business Machines, right? Nope. Tough to find that. The name of that company is? Sorry, ranking values. International, I probably spelled it wrong. See where they are on this list. Here they are, about 235 bucks. They're great percentage down here. They only have to move 2% this week for you to make money, is what that's saying. Anything over 1.8, their spread range is really low, meaning there's a big market for these options and they're priced very, very close to the dollar, because you can see that and understand how good that really is. But that one universal number that I gave you of like the 2.6% or whatever, yeah, they're within a $5 or $2 spread on their price of their options at strike price 127. Apparently, this is a very tight market. It means you're going to be able to sell at a very reliable price when you have to. They're showing up as number one. It's saying that if you spend 235 bucks on IBM options that expire Friday, May 26th, that this number right here of this 2.6 is saying that, I think what it's wanting to say is that there's a 97.4% chance that they vary by more than 1.8% this week. That's what I think this actually kind of means. Because, I mean, they had no problem doing it last week. They just kept going up. They went up by like $4 a share last week about. So they went up to about 400 bucks, which means if you'd held last week's option on IBM till its maturity, I believe you would have intrinsically made about $400. So the cost of options being around 234, you could sell for 400. And at some point, I believe even more than that, because I think they were up more on Thursday, if I remember correctly. Point is, they did great. And say you sold it for even 300, like making 75 bucks on a 235, you're making like 30% on your money. That kind of thing. If you can make 30% on your money every week, you'd be a really happy camper. Let me just say that would be incredible. So IBM is kind of predicting something like that. What the algorithm doesn't do is it doesn't tell you how far they are going to move. One way you could infer that is you could take today's move and you can multiply it by 5 sometimes. And that is not a terrible idea, but that's also not totally accurate either, because they're going to move in both directions. And today may not have been a representative day of how they generally move on a day as well. So the point is, it's a complicated answer, and I don't know the answer about how far, but I do know that this ABS rank number, absolute value rank, that this is taking into account all the factors that I have found to be relevant so far, meaning how far they move, how far they have to move to break even, what the range of the bid and ask prices are, and the cost. That factoring in all those things and today's movement yields that number, which is a really awesome number. So we said IBM's a buy, and it just thinks that they will move more than 1.8%. There you go. AbbVie, this one I went over in the video I posted on my other channel, my channel for my name, Ken Braverman. I did that, and I talked about this. I also bought one of these on Friday because I saw this late in the day and I tried it. And it's giving you this low 3% number, which is why it's up here. But the reason why it's calling this company out is it's saying not a bad price at 267, right? This is not bad. that anytime you're paying 200 and something dollars to straddle a company buying a call and a put, that means the sum of the call and the put are 267, right? Like it's saying that you're going to get the call for somewhere between about 156 bucks, and you're going to get the put for like 112 bucks or something. You add those together and you about get 267. It's saying they only have to move $2.68 in one direction, call it $3 in one direction or the other. That's also a 1.8% move for the company. That's not that bad. It's really not. I mean, anytime you're hoping for more than a 2% move in a company, that's a pretty good thing to want to root for over a 5-day or more longer period, because it's just the natural oscillations of the market. What if you have a down day where everyone wants to take profits or something and everything drops by 3%? Your company gets mopped up in that drop and your put ends up making money. There's a lot of scenarios where your company moves more than 2% from this starting price at some point during the week. That's all we're doing here. And the more they move, the more you can make. So these numbers, it's pulling these companies up. It's saying immense value in these options, that the people that are selling you these options, somebody's going to get hosed. That's what we think. Somebody's selling their option for not enough money. That's why it shows up here as a deal. So this one was a buy, and I bought that. APA, I don't know about APA. I haven't looked them up. This Chewy company, I haven't looked them up either. Morgan Stanley, I talked about in the other video. That one was a good one as well. Foot Locker had a crazy day on Friday. And so this being berserk here, like this number right here, I almost want to color it. Whether it's whatever direction it's in. If it's really extreme, you should watch out, because that means that they just had an extreme day. And if they're not continuing on that path, you've got to watch out. So even though I recommended Foot Locker, because they're super cheap, they moved 11 bucks on Friday. They'll probably move more than $2 or $3 the rest of the week, but they're also a low share price at only like 30 bucks. So they're not a great pick. This number's low because their share price is low. Starbucks and eBay were good ones. Low numbers. Starbucks a 105. Yeah, I mean, look how cheap eBay was. eBay, because it was just exceptionally inexpensive. That $1.26, like they got to move. They move $1.50 during the week, and they're a company that apparently will do that, and the algorithm is picking off on them being, see their movement of only 64 cents, but that's still like half of the way they need to go, like on a normal day. So that it makes sense that they will move more than $1.50, and that's where you make profit there. This is the order, right? And I'm a fan of doing this with Roblox. Shopify sounds like something I want to try as well. So that's what the list looks like right now. Well, as we update and the week starts on Monday, and I start updating this thing currently, we'll be able to do this and refresh this, and this list is going to change. And we'll track the ones that we said to buy to show you how well this algorithm works. Like watch AbbVie out of nowhere, because they're $145 a share. They're a reasonably high price stock. They just have to migrate. They just have to move. They got to move, just $2.75, and they're around 145. So it's like they go below 142 or above 148, you have to make money if you sell at that point intrinsically. That's really what I'm talking about, making money here. And it's like, that's just not a lot. And so why would they be impervious from just natural movements? If it does happen, it happens, but you're still only risking 267 bucks. And because you have a call and a put, you have action on either side or either direction. And therefore, you always have some intrinsic value depending on what their current share price actually is. It's not just going to sit on 267.00 and never move for 5 days. That's not going to happen. At some point, someone's going to make a trade, just like every other company that's moving every second. So if you sit back and you wait for that fluctuation to get into a profitable zone for you, You determine when you want to make a sale, but there's a lot of area to guarantee profit selling one of the two. And then you still have the other one. And if the company flips and goes in the other direction, the other one that you're holding may also have monetary value that could be profitable. So it's a strategy that involves, just a whole lot of options, a whole lot of future scenarios that can go your way. And very few, only one outcome is bad for straddling a company. And that is the stock price does not move for the term of your option and hardly moves, and there's hardly any trade. That's the only outcome that causes you to maximize loss. Any other outcome, it going up a little, even going up a little, your call at least appreciates in value for a while because you're in the money. So, even if, like, say AbbVie, keeps going up $1 and down $1 every day, something like that. Well, at the end of the day, or toward Thursday or Friday, you'll be able to sell one of these for over $125, most likely. At least one for half, depending on where they are. Because they're going to be a certain amount away from your strike price. So every penny above or below the strike price, depending on which option we're talking about, the call or the put, every penny is worth $1. So if they're sitting around at $145.31, we have $31 in intrinsic option value in your call at that point. That plus the premium of the time remaining on it, which is what people pay for, will get you like $100 or something, depending on how they're moving. And so that's how you can at least guarantee some of your money back, even toward the late stages of the week, if they haven't moved on Monday, Tuesday, or Wednesday. But you're giving yourself Monday or Tuesday or Wednesday. And in the limited history that I've been doing this has been basically no problem that you are flirting with or going into a profitable zone with these companies. Day 1, day 2, day 3. Yeah, like there are massive changes because it's options, and you're just dependent on pennies and dollars here in the actual share price. Not, that you're getting 100-fold movement on your money basically by having the options contract, which applies to 100 potential shares that could be purchased. That's why you're able to leverage essentially 100 shares for the cost of 1/100th of the movement. And it's just fascinating to watch how easy it is to get above the cost of the option price very quickly. And it has to go quickly because you only got 5-day options we're talking about, but there will be discussions in the future about expanding and extending that option period to month or months, a longer period of time. We're going to pay a lot more for the options, but you're going to have a lot more time, and a lot more time allows you to have different levels of profit and tracking day to day. So that discussion about, but I wanted to make this work in just the shortest period possible, which is a weekly option every Friday. Can it hit these companies consistently every week? Week 1 of doing this was a success. In what looks like I hit about 80%. After I did all said and done, it looks like I profited on 80% of them. Only one of them, I lost more than 50% of my investment. I lost like almost a couple $100 on EXAS, Exact Sciences, which didn't move. But I bought that option on a Wednesday for a Friday expiration date. So it was a 3-day option. So Kenny was not listening to the algorithm. Got to give yourself at least 5 days. Shouldn't be buying, like the last time you're buying options that expire May 26th is going to be on Monday and maybe Tuesday early. But I would say you should stick to just Monday. And if you're going to be buying any options on Tuesday or further going into the week, you're going to be looking at the June 2nd or whatever. I'm sure. I think it's June. There's the 16th. There's the 9th or the 2nd. Yeah, I think the June 2nd period. There's probably a Labor Day in there somewhere. I don't know when stuff ends, but that's the one you're going to want to be looking at starting on about Tuesday. Until then, as we discussed Monday, I'm going to leave all the options in here that expire toward the 26th and beyond. I still have a lot to do. I haven't updated 1,243 companies. Like, I'm only one person, and you have to fetch this information yourself. So I can't seem to automate anything yet to get bid-ask prices because they're too volatile, and they're, I don't know whether they're proprietary on the exchange you're working or what. but it seems like it's a very difficult thing to find, even on Polygon. So anyway, point is you have to look into these because they're changing every second when the market is open. And there's implied changes in them if you think about news and things that are happening to the actual share price after hours. So the value of this and the bid ask price that we're talking about in the cube here is really important information, and it's totally dynamic. So it's one thing to get an idea of what it is, but you also have to look every single time you're going to make a trade. Now, the other thing I wanted to talk about was, let's see, more sort options. We're going to sort by the worst companies of the day. No, it's the best companies of the day. We're going to sort by the worst companies of the day. Sending. Because we'll focus on those and look for any really good numbers. I know that Foot Locker number is there, but I don't think they're as good as that says. This Chevy, what is this? Chewy, sorry. Chewy. It's only 100. They're only a $32 share price. I want to remove companies below a certain share price. Man, do I ever. Because you want to be purchasing options on companies that have high share prices because there's more potential for movement. I mean, if a company is at $285 a share and they go to zero tomorrow by accident, sorry, Dillards, I hope that doesn't happen. But if it did, you would have $28,500 in intrinsic option value. You would have just earned that day. It happened one time with Meta, with Facebook, Meta went down $100 in one day. Like if you had a put option on Meta like a year ago or something when they did that, you would have made over $10,000 in one day if you were in the money. That's the kind of crazy stuff that can happen with options. And so if you have a lot of options in a lot of different companies and you accidentally walk yourself into one of those days, you're like, wow, that's found money. And that's going to happen as well. So that sometimes that's going to hit some of these companies that have great ratings. It'll probably be an accident, but it will still happen and you'll receive the benefit of that. So Meta's number is negative 82. Really? Super expensive, huh? I want to update them to get an idea because I'm starting to think they might be a good buy if you can get them cheap. Meta is at 245, 440, and 455, 355, and 370. All right, I think that got cheaper. They always move around and do that. Numbers change. So they're now still a bad number, $800. $800 for them to move 3.3%. You want this number to be below 3, the break-even boom number. That's how far they have to move for you to profit. You want this under 3. And that's why it's kicking this number out is not very good. So it's not recommending the straddle strategy on Meta. Alphabet, I think, is going to be a yes. Oh, Microsoft, I want it to be a yes, but it's not. Alphabet didn't move a lot on Friday. This will change. They'll probably, this number will change when they have a day where they move more than 27 cents. That's the problem with this day. So they just didn't move a lot, but that changes the ranking on a company. It can only make them really bad. It can't make them really, really great because the other factors matter. But here it does skew it off when they don't move a lot in the day. So that is a problem I have with this formula. Sort of. We'll see how often they appear there because we'll be checking in on these companies all the time. All right. Well, anyway, I just wanted to show everyone that the algorithm kicks out information and it says buy these. You know, it said if you wanted to like invest $1,000, it's like to here. I don't know this APA Corporation. No, not this one, not this one. The ones with higher strike prices. Starbucks. I would say Roblox. These are the ones that after I remembered reviewing and eBay too, really. So I remember reviewing it being like, yeah, there were some good things there about eBay because it's so inexpensive. $126. That's so cheap. I don't think I bought an eBay, but I need to do that. And then Roblox. So that's 6 right there. That, if you add up what the cost of that is, you're looking at Stanley, the estimated cost of those 6 options is $1,300 about, right? Well, based on these numbers and how easy it is for these companies to move these dollar amounts, I'm turning that 1,300 into over 1,500 this week seems like that's actually probably going to be easy, first of all. So I'm talking about 15% probably as a given, just easy. If you just sold everything when it gets up like 15 or 30%, you'd probably be able to do all that by Wednesday. I bet you will by like Wednesday or Thursday, that most of these could already be sold for a 30% profit or more. If you did that, you would start to accrue and get to a little over 1,500. Now, that's nice in that, who doesn't want to guarantee 30% profit in a week? That sounds fantastic, right? Well, you'll like that. And I did pretty much a similar strategy to that last week, and I was pretty happy with my results. However, I also left a ton of money on the table by doing things like selling my IBM on Wednesday when I only made like 15% on it or something. And I would have made almost 100% on it had I held it because they kept going up. So I think that what I'm learning and probably what I'm going to go through as I review this every day is I'm going to say, all right, we're going to watch how much the companies move on day one. And if they double your money, like if something goes straight up and you can sell this 234 for $500 or something, because IBM goes up by like $4 a share tomorrow or something like that, or goes down $4.50 a share, who knows, like whatever it is. If they move by $400 or $500, all of a sudden your option's worth $400 or $500. They move $4 or $5, that's $400 or $500, whichever option you have. So you could sell one for 500 because you're like, oh, it's Monday and there was some crazy weird change today, and I just doubled my money and got out of that. And you still have the other option in case things switch around the rest of the other part of the week. That's what you do on day one. But if day one they go up by a couple bucks and you could sell this for, let's call it $270 or something like that, you'd be like, all right, well, I could make this $40 here in one day. It's like 15% on my money. That's a really great return for one day. Sounds awesome. But I don't want to miss out on another day later this week where they move even more and I'm further in the money and I could now sell this for 50% or 75% if I just waited one more day. That's the kind of thing where I don't know the answer to that. I'm going to kind of experience it, but there are going to be cutoffs where you sell something when it's up a certain amount of money in a period of time. And then there's also what happens as you get later into the week. How desperate do you get? What kind of profit or even loss will you tolerate when it is Thursday, for example, and things are hovering and not looking great for you on your option? Where do you draw the line on it, or what kind of profit will you take? I always feel like by Thursday, if you've got an option that expires on Friday, if I ever can break even on whatever I have, I'll take it. I'll be like, all right, I only have one more day on this. Like if they didn't move enough, but I can actually break even right now, I will take that and be happy with not having lost anything. Because less than 2 days, one day or more is way too risky for trying to play this. Sometimes you'll have to, because there'll just be no other choice. Like, I shouldn't say that. You can always sell for something, but sometimes you might get stuck until later. But really, you want to make decisions on everything by Wednesday in my mind. Only in some rare instances would I be excited to hold something going into a Thursday and Friday. So really all this, the change in value that we're anticipating for these companies, we want to see significant strides toward that and overcoming that break-even boom number by Wednesday, really, by 3 days. And some of these options I purchased on Thursday or Friday of last week, yesterday or the day before. So they had more than 5 days on them to begin with. And for example, one of the ones that I have that I'll discuss is I have Oracle. Oracle comes out with an 8.7%. So that's under 10. I haven't talked about the companies that are under 10. I focus on the ones that were under 5% ABS rank. This is still a good rank, not expensive, 227. Um, they are about $100 a share. I saw a lot of good things here, and I went with it. My Oracle is, I think it's like at exactly the amount of money that I can profit. Meaning, I think I paid $235 for them, the two of them, and I could sell it for $234 right now or something like that. Like I'd be down like $1. And that is after one day. Like I picked it up on Thursday, and Friday's activity of them going up slightly, not even that much, right? This is how it works in practice. The act of them just going up by 50 cents made my options almost up money. Like they're getting super close. Like the call option is getting really close. It's just the call option we're talking about. So the put option also has a value. I don't know what that value is. I could double check. I am going to double check. Just want to give you exact numbers because it's pretty cool that how quickly this moves and how easy it is. Yeah, Oracle, it is the 101 call for May 26th. And yeah, it's between 228 and 241 is what it's going for. The other Oracle I have, which is the put at the same number, is going for $41. So I shouldn't say that I can break even. I can do more than break even right now on my Oracle, everybody. I can actually make about $40 because you could sell the call and the put if you wanted to. And you would be up $40. So after one day of purchasing this option, this 101 strike price, after one day, I'm up $40, right? It's not that bad on 220 something dollars. Like it's 20% almost that you're up. Now, I am not selling. I didn't sell it on the first day. Why? Because it's only 20%. And I thought, if this thing has 5 days left on it, what if they go up again on Monday? You know, what happens then? That all of a sudden I'll be able to sell a thing for $300, $400. Let they go up a couple bucks or something. There's good news. Who knows? So what you're wanting to have happen, like I said, basically is you want Monday, Tuesday, Wednesday to push you far enough so that you can make profit on the options and companies we're talking about. And I'll just keep updating and keep telling you what it says, but it's going to do amazing things because how bad can it get? It's not like you're paying a ton of money for options. Look how much you can pay for some companies' options. You can pay almost 12 grand for AutoZone's options. You can pay almost 5 grand for Chipotle's options, which means they have to move $50 a share in either direction. Now, there are really high share price companies, so that's actually possible, but it's also a different kind of risk. If you're spending $5,000 on something for a week versus 228, yeah, that's right. You could lose up to $4,700. Here, you can only lose up to 228. And what are you trying to do? You're trying to get dollars of change in stock price. So yeah, I know they're 2,000. They might move by $50 a share in a day. They only move 10 on Friday, and they got to keep moving 10 in the same direction every day for you to get there. It's a lot of money to risk. I'm not saying to buy this one because this seems like a tremendous risk. This does not seem like a tremendous risk. This seems like the only way you lose is if Oracle doesn't move off 101 for the next week. And if they go $1 or $2 in any direction, more than $2 in any direction, you have to make money selling intrinsically your option. More than $2.50. They might not, but they'll probably will, or at least they're going to look like they will at some point. And just like after day one, where I can turn a profit right now, you just kind of like instantly enter into profit zone if something moves even more than marginally. That's where this algorithm is just kicking out and crushing it because it's doing exactly what I want it to do. It's saying, these are great buys. So buy them and watch them make money. let's see if it happens. I mean, there's a lot of reasons it should. And you can see why Foot Locker is not necessarily great here. Super distorted day. And this other one, this had a super distorted day too, kind of. Anything that drops, low share price, then whatever. All right, we've talked enough. That's the podcast. Get interested in straddling stock options. We've all got to come up with new ways to make money and partake in the economy that is the world. If AI is going to end up taking all our jobs, it's going to take our jobs. If it takes our jobs, we have to create new jobs and create new ways of exchanging money. One of the ways that is kind of manifested itself is through a crypto market, right? There's crypto coins everywhere. I saw a story about some guy that created a crypto coin, asked like Chat GPT how to create a crypto coin for him. He did it. Now his crypto coin has like a $20 million market value or something crazy. Yeah, that's the kind of world we're living in now. Well, when it comes to getting involved in the legal marketplace that is the stock market, there are things that contracts you can legally get into that have these values and fluctuate immensely on a daily basis. So finding the ones that have super value and are not that expensive with a lot of potential upside is what this algorithm is doing. And if you know anything about the algorithms I do, even if they have their issues, they also provide so much. And so this is doing the calculation on 1,500 something companies automatically, because why would you ever think that IBM is a really strong pick in anything? Like, why? Well, it knows something we don't. And that is, this is really cheap for how they're actually moving. And why the marketplace hasn't caught up with this and priced the options more appropriately, I don't think the market looks at it like this. Like, you're probably not going to make thousands of dollars on IBM. They're probably not going to move more than $10 or $20 a share. That would be pretty nuts if they did that. But the fact that they're probably going to move more than 1.8% is the real important question that you're answering, which is, are they going to be a profitable purchase this week? It's real tough for them not to be profitable. It's real tough. And all those other scenarios where they go profitable, they go profitable. And they're somewhat related to the AI conversation, even though they're not getting lumped in with Google and Microsoft, because they're not. Nobody thinks of them like that, but they did have Watson. They're probably doing something. They talked about moving employees, getting rid of them with AI and stuff like that. Like, they're doing something. So maybe that's another reason the algorithm is doing such a good job with this. We'll find out. All right. So good luck, everyone. May all your trades be winning. That's the update. That's what I'm doing. Not doing sports algorithm stuff because it was just too much time for not enough or negative money. And so it's become something where we can all share in this marketplace and show you how to shave off profit from the volatility, because this is clearly a method of trading securities that has a lot of potential upside with sort of minimal risk in a way. And that's pretty exciting. All right. So good luck, everyone. May all your trades be volatile. All your stock.